What's up, everybody? Zach McDonald, your real estate agent, and I got Dan Keller with me here today, branch manager, Cross Country Mortgage. Today we're going to talk a little bit about rates. We're going to talk about the bubble, if you want to call it that, and we're going to talk a little bit about just some financial literacy together here in this time. So why don't we start off with what everybody really wants to talk about, and that's the bubble. I know you've got some thoughts on that, Dan. So I'd love to hear kind of how you're having these conversations and then what your opinion is about where the Seattle and local real estate market is.
Yeah. Well, it's something that's on everyone's mind right now. I can remember back when, I was a young homeowner, and it was 06 to 07 and 08. Well, in 06 and 07, no one was really talking about a bubble. It was, oh my gosh, you can buy a home.
Yeah.
And my wife and I being, newly married and starting a family, we did that. We did exactly that. And then the bubble happened, and then it popped, and the house that we bought for $325,000 went up to $460,000, and then went down to $220,000.
That's not good.
Not good.
No.
But I think what people are missing is that was a once in a, I want to say, not even a lifetime, even greater than a lifetime event that happened. There was fraud that took place. There was a lack of regulation that caused that, and a lot of greed. Okay. Since then, the Obama administration came in, established Dodd-Frank, the Consumer Financial Protection Bureau, a lot of measures that are still in place in 2021 and 2022. They're not going anywhere.
Nope.
To prevent all of that fraud and all of that from ever happening again. And so you have to understand, prior to 2006, 2008, Zach, nobody talked about real estate bubbles. So when I have these conversations with clients and with friends and professionals like you, let's eliminate 2006 to 2008, because that will not happen again with these regulations. Therefore, there's no bubble. What's a bubble? Okay. So when people are referring to a bubble, their youngsters are referring to what their parents or people my age went through in 2006 to 2008. So because we're not going to go through that again, we're not experiencing the same situation, I don't like to refer to anything right now that we're seeing as a bubble, because it's not going to happen and it doesn't exist. How I like to explain what we're seeing right now is simply a supply and demand issue, one.
It's a big part of it.
And then number two, in the Seattle marketplace, the Puget Sound, we have more people that are relocating to this area than we have houses for. And I'm talking apartments and single family homes.
Certainly.
Now, on top of all of that, where I come into play, what I do for a living, mortgage finance, mortgage interest rates, or the cost for financing a home is lower than it's ever been. All right. So you take supply and demand issues, you take a major, hot, robust, healthy jobs market. I think everyone can agree that Seattle has one of the top jobs markets in America. And then you talk about the affordability of financing, low interest rates. That's the market that we're in right now. That is not your traditional bubble. That does not define a bubble. That defines a healthy real estate market. Where it gets a little bit unhealthy is the fact that certain population of home buyers just are not getting a fair opportunity right now to purchase.
That's true.
So I wrap this all up and close this down with what you need to pay attention to right now is interest rates. As interest rates go up, we will not see a bubble pop. We'll see a slowing down of appreciation or a slowing down of the market. Maybe more people will be reaching out to you to sell their home, and it might take you a little bit longer to sell that home.
What, longer than like a week?
Yeah, maybe like a month or two, right? Which is a normal, like a healthy market, right?
Yeah.
So that's probably the most important thing I am encouraging people to pay attention to right now are interest rates. As soon as interest rates start going up, you're going to start seeing home values not go up at, what did King County go up last year? Like almost 20-something%?
Close to 20% on average, yeah.
So instead of 20% appreciation, you might go back to the healthy norm of 7 to 12%, which is totally healthy.
It's a lot,
yeah.
So what are some of the other factors that play outside of supply and demand and interest rates that you could look at the situation now and say, we're not in a bubble? What are some of the other things that you're looking at aside from those things?
Again, to follow up on the 3 factors that we just talked about that really help show that we're not in a bubble, that this is a healthy market and somewhat sustainable. You have to go back to 06, and this is data. So I want to preface this. This is data that you can find on the internet for the county that you live in, all right? So I'm not just sitting here going, oh, this is my opinion. If you go back to 2006, for example, in King County, and you look at home affordability. So a home in 2006, in the peak of the previous market that collapsed, right? That particular home has gone up 41% since the peak of the last housing market.
And that's across King County.
Across King County, for example. And basically it's across the US, but we went right into King County. It's like 41, 42%. So that home that was worth, for example, $400,000 in 2006 is now worth let's just say 550, 560-ish, right? Something around that range. People are like, oh my gosh, home values have gone way up. What I need to explain and what you need to understand as a home buyer or a homeowner, yes, home values have in 15 years gone up 41%. That's a lot. Maybe outside of the normal healthy range, but get this, that same home that Mr. and Mrs. Smith bought in 2006, that same home that's worth now 41% more, is $52 a month less expensive to buy right now.
Explain that.
So even though the home value went up, 30-year fixed rates right now are 3% or under.
So they're lower.
30-year fixed rates in 2006 were 5.5%, 6%. So don't focus on home values per se. Don't focus on the bubble and the fear and what the media is going to tell you. Focus on the facts. The facts of the matter are, in 2021, it's more affordable to purchase a house right now in King County than it was in 2006. But here, it keeps getting better.
It's kind of crazy to think about it that way.
This is what's going to seal the deal and what makes a ton of sense. Nobody's talking about this. This is why you work with a professional like me, because I understand this
That's why
stuff.
we're having this conversation. It's good.
Get this. Household income in King County in 2006, total household income was approximately $76,000 a year. Today, it's almost $120,000 a year. So not only is home affordability more affordable, housing is more affordable today than it was in 06. Homeowners are saving 30% more each month as a result of their income going up as well.
Wow.
So are we headed toward a bubble, something that's unhealthy, something that's going to pop and collapse? Financially, no. Financially, no. Homeowners are in a better position today in 2021 than they were in 06.
So it sounds like a lot of it has to do with interest rates, and we've got a lot of competition, obviously. There's a lot of demand for not enough supply, and then we also have incomes going up. It also sounds like people are saving more, so they're in a better financial position. They might not have to sell their house immediately if there was a tough time. And it also seems like there's quite a bit of equity in people's houses. So it seems like we are in a pretty stable spot. It sounds like you would say. Yeah.
Very stable, considering in 2006 to 2007 and 8, fake money. Okay. Fake approvals, because they were people that were qualifying for mortgages back then were qualifying for no income, no asset type loans. If you had a good credit score and you had a little bit of money down, we're not going to verify your employment. It's okay. There was fraud, a lot of fraud. Now, I wasn't in the mortgage industry back then, but I'm telling you, my wife and I bought our first home, Zach, and she was a barista.
What did you do for work?
I was personal training athletes and making a majority of my money cash on the side.
So basically no
not a W-2, not a W-2 employee. And so
is this beyond the time the IRS can come after you?
No, I mean, we were claiming we were claiming that. Absolutely, yeah. Because here's the thing. We were paying taxes on that. My point is Jenny and I would not have qualified for a mortgage in 2006. We wouldn't have, because we didn't have documentable two years of documentable income. Now today, from 2008 on, every single one of your clients has to go through what's called underwriting at a lender. And you've bought homes, and I've helped you guys with mortgages. Yeah. You know it's difficult, especially being a self-employed business person. So yeah, it's a completely different environment. It's healthy. Don't listen to the fear. Listen to the pros. Don't listen to the media. Listen to the pros.
So speaking of money, I think that's an important topic as well, something that you talk a lot about as well. You talk about getting people into debt and then helping them get out of debt.
Yep.
I think personal finance myself is really important, and continuing to improve in how I invest and how I earn and all those things. So can you talk a little bit about what you've been talking with your clients about? Because I think some of the things that you talk about are really basic and simple, but also really, really valuable.
Yeah, I think one of the most important things, you just said it. When I'm your mortgage guy, I'm putting you into the largest debt of your life. And I consider it my responsibility to help you get out of that debt as quickly as you can. Okay, now whether that means paying off your mortgage earlier than 30 years, 30 years is a long period of time. So what I try to do with my clients is just, number one, bring about awareness that 30 years is going to fly by. Okay, 15 years is going to fly by. I can remember yesterday my daughter was born. I can remember holding Allie for the first time, thinking, what am I about ready? What did I just do?
Yeah.
Not knowing how I'm going to support this family, not knowing a lot of things. That was yesterday, Zach.
Close enough that you can still even want to tear up thinking about it. You can
I can feel it.
I can see that you feel it. It's crazy.
So, I take that same emotion and that same feeling to my clients, that 15 years is going to fly by like this. What I didn't have 15 years ago was a mentor, a real estate professional, a mortgage lender, a financial planner going, Dan, set aside 10% every single month. Set aside X number of dollars and put it in your 401k and your IRA. Buy an investment home every other year. Buy a home, live in it for 1 year, rent it out. Buy another owner-occupied home, live in it for a year, rent it out. Build a portfolio. I didn't figure it out until I was about 35 years of age. So that's been 10 years. And over the last 10 years, I've had to make up for lost time. So it's been a passion of mine, and it is a passion of mine now, to teach my clients how to come out the other side of home ownership in a better financial position. So part of that is there's a big gap right now in the U.S. relative to financial literacy. So I commend you for having me on and talking about this. People need to understand the fundamentals of financial literacy, the fundamentals, things that you need to be aware of that will help you come out the other side of home ownership, whether that's 15 years, 20 years, 30 years from now. I focus on 15 years because it's so relevant to me.
Yeah, sometimes you get lost thinking too far out. Even 15 years can feel like a long time.
It does, but I mean, I'm sitting here as a 45-year-old man going, 15 years it happened like this.
Yeah.
You know? So my little daughter is now getting ready to drive.
That's crazy.
In January. So that's crazy. Now, and I can vividly remember clearly over the last 15 years. It's still in my memory, and it hasn't been too long. So the financial decisions that you make today impact your financial situation tomorrow. Just remember that. So there's 4 or 5 basic fundamentals that I teach my clients. We could do a whole episode on this. We're not right now, but you can go to budgetwithdan.com. It's free. You don't have to put your name in and your email. They're all PDF. Just click on it and you can download, save the PDF. But there's a financial awareness test. It's 15 questions that really helps you better understand where you're at now relative to where you want to be when you retire. Super healthy. I fill that out twice a year, and I know you do too. The second thing is down at the bottom of that, it's from The Millionaire Next Door, the best-selling investment book, The Millionaire Next Door. And it's where are you now? And it helps you figure out, are you on track numerically? So there's a few things, some resources there. And then there's a 12-minute video. And I know both you and I subscribe to these ideas, the 6 steps to financial wellness, to financial wealth. And so I would encourage you just to watch that. There's a ton of helpful information in there, but that's a big passion project of mine, to teach younger kids, because I now have a high schooler, and I teach 1 semester a year at the University of Washington, and just get this information out to people. So again, they can come out the other side of home ownership in a better financial position as a result of our relationship.
Yeah. Can you speak to those fundamentals just real briefly? You didn't really want to get into it. I don't think this is necessarily the time to spend 20, 30, 40 minutes talking about it, but can you give us those
Let's do four.
Fundamentals?
The 4 core financial fundamentals. Number 1, have a reserve account. Have a reserve fund. Typically, if you go to budgetwithdan.com, you can see my budgeting spreadsheet and you can download it. Basically, you add up all of your expenses every single month. Take a bank statement from a month ago and go, okay, here, I spent all this money on water, utilities, electric bill, cell phone, rent, whatever it might be, car payments, student loans. Add them all up. Let's say it adds up to $4,000 a month. Times that by 3. So a good emergency fund is 3 months of your total living expenses. Okay, so that would be what? $12,000. Okay, so
there you go.
Once you have $12,000 saved up, for example, step 1, you've accomplished that. That's great.
Woo.
Step number 2 is to call a guy like Zach and buy a house. Buy your first house. Buy a house and live in it. Now, this is if you go to my Instagram, I teach you a couple different ways where you can become a millionaire real estate. You can become a millionaire through real estate. Buy a home, live in it for a year, rent it out, buy another home, owner occupied, live in it for a year, rent it out. Do that 5, 6, 7 times. 6, 7 years later, you're a multimillionaire. You have a multi-million-dollar real estate portfolio. Okay? So step number 2 is buy a home and live in it. Okay? You can buy a home with as little as 3% down. In some areas you can buy with 0 down, but right now you can buy a home with as little as 3% down. You can get a friend to house hack. If you don't think you can afford it, or you don't want to afford a $3,000 a month mortgage payment, for example, you can rent out a room for $500. I did that when I was younger. My first condo, that's what I did.
I rent out my basement. It's real. I still rent out my basement. I've got 3 kids.
There you go.
It works.
So emergency fund, number 1. Number 2, buy a house.
Do you have to buy a house every year?
If you want to. There's some people that are like, you know what? We just really don't want to do that. We want to buy our own house and live in it for a while. That's fine. To each their own. There's other ways to make money. But if you really want to invest in real estate, if you say, listen, my income probably isn't going to go way up. I'm not entrepreneurial, but I would really like to build a better financial life for my family. That's the easiest way. Buy a home, live in it for a year, get tenants to cover the mortgage or make a little bit of money on them, do it again. We can teach you that plan, both you and I. We help clients with that. That's one way. The other way, if you just say, hey, I just want to live in a house. I want to own a house. Great. That's step number 2. Step number 3 then, if you're going to take that route, step number 3, make sure every single month you're maxing out your IRA and your 401k. That's going to be approximately, between the two of them, $26,000 a year max. Okay? So make sure you're maxing out your IRA and your 401k. If your employer, especially if your employer matches, it's free money. Do it. Okay? And then step number 4 is invest in the stock market. Okay? Invest in the stock market. And that's something that over the last 10 years, I have become more vulnerable, more trusting of my financial planner, and I've surrendered to my coaches, and just everything that's left over every single month, I give to my financial planner. And I'll tell you what, I forget who said this. Could have been Einstein, but he said, compounded interest is the 8th wonder of the world. It's the most valuable thing that we have at our disposal in the United States of America, and it's the truth. So let me recap. Number 1, emergency fund. 3 months of your total household expenses, living expenses saved up. Number 2, buy a home and live in it.
Buy a house.
Number 3, max out your 401k and IRAs. If you can't max them out, contribute as much as you can to them. And then number 4, invest everything that's left over into the stock market. And you get to a point in your life where you can do all 4 of those, you're well on your way. And retiring well off is not that far off. You're getting your money to multiply. People say that all the time. They talk to me about money, and they talk to me about mortgage and real estate. And younger kids will ask me, man, Dan, you own these houses and you have this money in the stock market. How do you do it? I have taught my money to grow. I train my money. I don't do anything. I don't invest in anything. I don't try not to spend my money on things that don't go up in value.
It's pretty good stuff right here, guys. So last thing I want to talk about today was interest rates, because interest rates have been super low for the last year and a half or so. And it's definitely fueling the real estate market, and it's keeping prices going up. What's first of all, going to happen when we see interest rates go up? And then secondly, when do you think that's going to happen? What are your thoughts about where interest rates are and where they're going to head in the long run? It doesn't seem sustainable to me.
No, it doesn't. And at some point, America's got to start making money again on their money. They've been giving it out for free for so long, Zach. They have. I mean, if it's not one thing, it's the previous housing in 2008, 2010. Mm-hmm. Obama came in and said, the government's going to purchase mortgage-backed securities to buy down interest rates. If you think about it, mortgage interest rates have not gone up. They've been at historic U.S. record lows since 2012, 2013.
Yeah,
they've peaked up into the fours a little.
We saw a little bit over 5 back in 2018, 17.
For a second, and then back down. So, we saw in mid to upper fours, flirting with 5 for a second, and then boom, right back down.
Yeah.
And so in comes COVID. The government, in order to keep the economy moving, what they can do at all times is just go print more money. Which they're doing. Huh? That's how they do it. The Federal Reserve has no limit. Debt ceiling doesn't exist, right?
Yeah, what's that?
Yeah, so you're hearing the Fed talk right now about this word called tapering. Mm-hmm. It's going to happen. It's going to happen. It was supposed to happen in October. It's not. Maybe November. It's going to happen at some point. What tapering means is the U.S. government is going to slow down their purchase, slow down them being involved with artificially lowering interest rates, okay? For right now, we're still 30-year fixed rates are still in the upper 2s to low 3s, right?
Yeah,
so they're still
low.
Buying a ton of mortgage-backed securities. The second they start tapering and you actually see that in the market, it's going to be a test to see if the economy can handle it. They've tried it before. The economy couldn't handle it, so then rates stayed low or they stayed kind of where they were, right? And then we had COVID hit, and they dropped them back down even more.
To keep the economy going.
Yeah, so 2 things to consider. Recovery from COVID, economy getting back on track, small businesses starting to do better.
Yep.
And then tapering, okay? Tapering. So, just be cautious of that.
So COVID and tapering, those are the 2 things to keep an eye on. No crystal ball, though.
No crystal ball, but what I tell my clients when they ask, hey, when are rates going to go up or what do you think? I think the most transparent and truthful answer is, I don't know. Yeah. I mean, if I had to give you nobody wants my opinion or prediction, right? They want somewhat fact-based answers. So I would say, as you hear in the media or you talk with me, or you could subscribe to my weekly emails where I talk about rates, are they going up and why?
It's not a bad idea.
Every week. But just focus tapering, and as the economy gets back on track with COVID, rates are going to follow quickly right after that.
So what happens when rates go up? I mean, people are able to buy houses right now. They're getting a super good rate. What happens when rates go up to the affordability of those houses?
Awesome question. So let's just say, for example, that client that you just sold that $800,000 house to, and they put 20% down on that house. That same house, if rates go back to where they were pre-COVID, we're talking February of 2020, 4.5%, 30-year fix. That's still a very healthy 30-year fix. That's a good rate.
Yeah, it's a great rate.
If rates go back from where they're at right now to that, you're looking at almost $500 a month more for that house that you just sold a client a house to today.
Wow.
Yeah.
That's a big jump.
It's a big jump.
Price is the same?
So price is the same. So this is the other thing that I tell all my clients. Don't focus on home value right now. Don't focus on overpaying for a house. You're not overpaying for a house. If the seller wants to sell the house for $800,000, you're willing to pay $800,000. In the back of your mind, you're like, well, I would never pay, or my dad would never pay $700,000 for it. It doesn't matter. It's $800,000. You're willing to pay $800,000, and an appraiser through data and comparable sales appraises it for $800,000. You didn't overpay for that house. You paid fair market value for that $800,000 house. Don't focus on home values right now. Focus on the rate. The rate is your opportunity, not lowballing a seller, because you're not lowballing sellers. And that time will probably not happen for a long time, right? Focus on the opportunity right now, which is historically low 30-year fixed rates.
Great thoughts, Dan. Well, thanks for coming on and talking with the audience here, and I always like to bring value, and you always got a lot of value to bring. Yep. So I appreciate you sharing some of that. Do you have any last thoughts as we wrap up?
Yeah, just like we said, I'm passionate about financial education. If you'd like to learn more, again, it's free, no strings attached. Budgetwithdan.com. If you have any questions, you can reach out to me. I'd love to have a mortgage conversation with anyone, like we do with so many of your clients. But that's my gift to you and your viewers.
Yeah.
Budgetwithdan.com, and I hope this information blesses you as much as it's blessed my life.
Yeah. Well, thanks so much for being on here, and make sure you guys go and subscribe to Dan's YouTube channel. We'll link it up down below.